Welcome to another Apollo Papyrus episode. I am Aaron Apollo Camp. For this episode, my interview guest has over 4 decades of experience in the investment finance industry and is the author of 2 financial nonfiction books, The Brainwashing of the American Investor and Retirement Money Secrets. His name is Steve Selengut, and here's my interview with Steve. Steve Selengut, welcome to Apollo Papyrus.
Well, thank you, Aaron. Happy to be there with you.
What has your experience over more than 4 decades in the finance sector been like?
Exciting, satisfying. It's been productive. What else can I say? Sometimes frustrating. Certainly about as interesting a career, as varied day to day as any I could think of. I guess that about sums it up.
Okay. Feel free to tell us more about yourself to our listeners.
Well, I started investing when I was 25 years old. I was fortunate to get my hands on a trust fund type thing, and it was not an insignificant amount of money, but it was totally in the stock market, and all names you'd be familiar with, like Exxon and IBM, Sears, which was a big name back at the time in 1979, or actually earlier than that, 1970. And then my goal in life was not to lose any of this and to make it grow. And I was hoping that eventually it would make me enough money to be able to quit my job and do something else. And it finally happened that way. I mean, I was making 4 or 5 times my salary and making money in the markets, and with income producing securities didn't involve any of the overhead like commuting to New York did. So I talked to 2 of my closest friends, my dentist and a fellow that a restaurateur, actually, that my wife and I met on a cruise, and convinced them that they should let me help them with their investing. And I showed them what I'd done for myself, and they agreed. So go push forward 40 years, and I've got $110 million under management for about 150 different people, families, and businesses. And I'm selling that business and starting a coaching business and writing the book, the Retirement Money Secrets, to tell other people how they can do the same thing. That's the story.
You mentioned your second of 2 financial nonfiction books, which is Retirement Money Secrets. Without spoiling too much of that book, what is it about?
Well, it's about, there's, let's say, 3 different things in there that are very important. The first one is the principles of investing, particularly 4 pillars of risk minimization that I talk about. Most people either don't realize it or are afraid of it, the risk that's associated with investing. In Secrets, Retirement Money Secrets, I talk about the 4 ways to minimize your risk. And the first one being to focus on the quality of anything you invest in. Make sure you identify it. For example, if you're buying a stock, you want to make sure it's profitable. I always used the fact that it was paying dividend as a good indicator that it was high quality, that it was making enough money to pay the share owners some income. How long the company's in business, and so on. So quality, you have to have a measure of quality of anything you buy. The next is diversifying your portfolio, making sure you don't have all your money in one sector. A lot of people right now are throwing their money at AI and other tech companies. And we all saw how that was a disaster, the dot-com bubble. Um, those things happen all the time and they're not predictable. So you don't want to tie up all your money in one sector or one company and things. So I emphasize never having more than 5% in any one security, no more than 15% in any one sector, and even 15% in my mind is too much. So that's the second pillar of minimizing your risk. The third one would be to make sure everything you own generates income, and you can be pretty fussy or greedy, whatever you say. My income requirements, I've got to be making at least 6% on the income securities I buy and at least 5% on the equities. And I'm not talking about gains in market value. I'm talking about distribution income that I get that I can spend if I want to or reinvest it if I prefer to. And finally, and this is the one that most people ignore, is profit taking, setting targets, operating your investment portfolio the same way you were doing would would operate a retail business if that's what you were running. You think of the securities you own as inventory on the shelves of your store, and you set a 5% markup or a 7% markup. And if somebody comes into the store, you sell it to them for that markup. You don't say, no, I think the price is going up tomorrow. I'm going to hold on to it. You sell it, you buy something else, put it on the shelf, and set a markup for that. So profit taking becomes the fourth pillar. Um, if you take your profits at a reasonable level throughout your investment history, you'll never be kicking yourself when you have a financial crisis like we had in 2008, when we have a COVID crash like we had in March of 2020. And I don't know if your listeners are old enough to remember the crash of 87 or even the dot-com bubble in 2000. But those things just wouldn't have been that big of a problem if you had taken your profits and diversified your portfolio further, including making investments in bonds, mortgages, real estate, income producing things in addition to your equity ownership. So that's, I would say, a third of the book. It covers risk minimization. It spends some time on dealing with the idea that the markets and interest rates are cyclical in nature. They don't just go up, they don't just go down, and they don't work necessarily simultaneously, the interest rates and the stock market, but they're always cycling up and down. And this tells you two things. It tells you what to expect from your portfolio, so you don't get all upset or bothered when you see that the prices are down, or you don't get all driven crazy with how wealthy you are when they go up. You know it's a cyclical thing. You know it's going to change, so you have to take advantage of those changes. You have to sell when your prices are up, and you have to buy when the prices are down. And so long as you've done that quality diversification and income thing I was talking about, you can kind of do it with impunity. You can make all market changes in either direction can be opportunities instead of problems. The final area of emphasis of the book is focus. And these days, most advisors, I mean, I could tell you about a conversation I had today, I mean, just this morning. Most advisors focus on growing the market value of the securities that they manage for you or that they advise you to buy and to hold on to. They never advise you to take profits. And they focus, like I said, on market value. They rarely focus on the income they're producing for you. But at the same time, particularly when you get near retirement, they're suggesting that you're probably going to need to spend 4% of your portfolio on your living expenses. So why they don't create a portfolio that it produces at least 4% in income so that you can be comfortable in retirement and not go backwards. Uh, I can't imagine why they don't do that when it's so simple to do so. I mean, I've been doing that for 40 years. Um, all of my clients made more than enough income without even considering the capital gains we were making, just on the regular base income that they received was always more than enough to pay them what they wanted me to pay them every month. We always had money to reinvest. And that's when you can go out on vacation, do whatever you want to do, not even look at your portfolio and say, okay, I know I'm making enough income to take care of this. And I know I have somebody there reinvesting the excess um, to make it happen. If I don't have a manager to do it for me, I can, these days, I can use my Fidelity app, check in, take my profits, reinvest the difference, and be ready for breakfast in the dining hall. You know, so that's pretty much what the book is saying, and it's a conversational story. It's a history of meeting somebody on a river cruise. I mean, that's what we old people do. We go on vacations, we meet other old people, and we talk. And in this case, we wound up talking about money and how the couple had liquidated, you know, several thousands of dollars from their mutual funds in order to pay for the cruise we were on. And I explained how my wife and I merely set aside excess income for a few months to pay for the cruise and didn't have to invade any principal at all. And that's the story. That's what it's getting at. It brings people to the point where they understand the markets, understand how to generate more income, what to expect, and to show them that they can generate more than they need and continue to grow the portfolio to take care of their grandkids' education, to go on cruises, to endow some charity they are fond of. Whatever they want to do, they'll have the money to do it if they operate in this manner. There you have
Uh,
it.
a saying of yours, I'm going to ask the next question here. A saying of yours that appears at the top of the front cover of your book, Retirement Money Secrets, is market value fuels the ego, income fuels the yacht. What does that saying mean?
Well, if you the first, what do you, Aaron, when you look at your investment portfolio, when your statement comes out online, the first thing you look at, I'm betting, is the market value. What's my market value? How much did it change from last time? Why did it go up more? Why did it go down so much? You don't look at the income that portfolio generates. And like I said, portfolios these days, if they're managed or even when people do their own thing, they don't generally focus on the amount of income that's being produced. When I look at my monthly statement, what I'll be doing in next week when my statement comes out, I'll be looking at the amount of income I generated in March. I'll compare that not necessarily with February, but I'll compare that with December. Okay. And I'll say, did I generate as much base income as I in March as I did in December? Was it less or was it more? Okay. It should be more. Quarter to quarter, your income will grow if you generate more income than you spend. That's that's a pretty obvious statement, I know. But that's what the goal should be. Okay, so that's what that means. If you just are growing your income and you have tons and tons of income, you can get on that yacht and you won't have any money to pay for the gasoline. You'll have to you'll have to go sell something. It's just like people with who think they have a lot of money when they have a stack of gold bricks hiding in this safe in their garage. But they can't go to the pharmacy and buy their prescriptions with it. They can't spend it. They can't go out to dinner and throw down a gold brick on the table. You know, they got to have cash. They got to have money. And the only way you can have that money is if you set it aside by making it either by working or by having your portfolio work for you harder than you work yourself. That's what that analogy is all about. The only thing that market value builds is your self-esteem, your idea that you're wealthy. But if you don't have income, that wealth doesn't mean a whole lot.
The first book you wrote, which you're not actively marketing, but I find it interesting for the title alone, which is The Brainwashing of the American Investor. Without spoiling too much of that book, what is it about?
Well, I don't, I've changed my style of investing, the nature of the securities I use to get the income. And the brainwashing book is still focused mostly on stock market investing. So that's why. Also, because the marketing company or the publisher I used, the first one went out of business, and the second one was kind of a fraud, one of those internet deals. Anybody who wants the brainwashing book can get it for free from my website. All I got to do is ask. Okay, so they don't have to buy it. But the other book supersedes it. It continues those same principles we talked about, but there's a type of security there that most people aren't aware of, and it's called closed-end funds. It's a type of fund, different from mutual funds, different from ETFs, but similar in the sense that they own the same types of security inside. So mutual funds, closed-end funds, ETFs, they own pretty much every stock you'd want to buy on the stock market. They own all kinds of municipal bonds, corporate bonds, government, all this type of stuff. So it's the same types of securities. But the difference between closed-end funds and the others is that closed-end funds are pass-through trusts, things like you'd set up in your will and estate so that the money comes in and goes back out to your people you want to benefit. So the trust doesn't pay any taxes, but the people who receive the money pay it. Well, these things have to pay us 95% of what they make, and it comes directly to the shareholders, unlike the others. And their objective is to grow their market value. They're not really interested so much in the income. There are exceptions. There are some ETFs and mutual funds that pay good income, but not nearly as good as closed-end funds do. So it's a whole different way of going about generating income. And that's pretty much what the book focuses on. And the brainwashing book was just barely, it was written when I was just barely touching closed-end funds. I wasn't entirely, full into that type of investing at the time.
You mentioned that you had the issues with the book publishers you dealt with. Could you elaborate a little more on that?
Well, the first one, Wasendorf Publishing years ago, they went out of business, and they never really, I didn't think they ever put any real effort into marketing the book. The other one was one that was going, it really, we edited the old book a little bit, and they published it. They gave me an online presence with it, but they kept telling me I wasn't selling any copies, and I could see the sales at Amazon, but not many of them. But I never got a penny. I didn't pay them a lot of money either for the work they did, but I never got one penny of royalties from them since the time it's been published. It's got to be 12 years ago at least, maybe more. But whereas with this one, which is published through Amazon and through my LLC is the publisher, and it was directly with Amazon. I mean, they've already told me I've sold nearly 2,000 books there, and it's at Barnes and Noble. It's at all the various ebook stores. So we've sold over 2,000 copies already, and so it's been fairly successful compared to the other book.
Uh, this is a question I didn't have written down, but are there any similarities to between like investment banking and writing the book, or was it quite a shock to you to go from being in the finance sector to writing books about it?
Well, I'd written articles all the time. If you were to Google Steve Selengut articles, you'd be busy reading for a while. And I have a whole inventory of articles at my LinkedIn place. But I was a hands-on investment manager. I was like, if I were one-on-one talking to you, I would be taking over your portfolio and running it for you, and you'd be getting those statements every month, seeing what I'd accomplished. So that was a hands-on type of thing. Writing a book about that experience was really kind of just telling stories. You know what I mean? It was like telling stories of different relationships you've had and questions people had that you wanted to answer. In fact, in the book, I have a chapter that's a Q&A session with my Facebook group, okay, where people are asking me questions and I'm giving them the answers. So it was so easy to write this down in in this presentation. Um, so much easier actually than what you would think of if you said you were in a finance career and everybody thinks of all these charts and tables and you have multiple screens up there with all these lines going in every different direction. I never really had that. I pretty much understood the gyrations of the markets. And even with the closed end funds, they're moving up and down all the time. And I just see this, like I said, it's like operating a retail store. One of them goes up in price, I take the profit and I replace it with another one. And I have these very strict quality rules that I apply to them, and I study them all, and I create universes of income focused closed end funds and equity stock market focused closed end funds. So I have over 200 different funds to choose from, and I pretty much own every one of them in my various portfolios so that in my business now as a coach, I can give these universes, these spreadsheets to people so they can use them to research these things themselves, you know? So it's a totally different than suit and tie, go to the office, talk to bankers and stuff like that. It's not that kind of environment. It's still a one-on-one relationship with people, helping them satisfy their investment needs, helping them get the most income from their portfolios. How do you take a rollover IRA that's totally in mutual funds and ETFs yielding 2% and changing it into a dynamic portfolio that's yielding 7, 8, or 9%? That's what my function is now as a coach. I show people how to do that. The book shows them where to go to learn how to do that.
My final question: what do you love most about living in South Carolina now that you live there?
Um, the climate, it's got a little taste. I mean, I have seen snow 3 times in the 20 odd years we've lived here. Um, it does get cold 2 or 3 days a year, down to 32 or something like that. So that's plenty. I've only had to pick up my snow shovel once. Uh, I like that idea. I don't need the snow. I like being warm. I like to be able to play golf nearly any day I want to. I can just, you know, weather permitting and time permitting, I can go out and play golf because the climate is there. We're we're 20 minutes from the ocean. I can be walking the beach, and we do that a lot, my wife and I. Just take a beach walk whenever we want to. I mean, and it's beautiful. It's beautiful there. The city is it's nice. It's cultured. It's beautiful. The dining in the area is as good as you can get. North Jersey, Manhattan are no better. Unfortunately, it's gotten pricey down here, and it's getting rather crowded. So it's a little bit tough to move around, particularly during rush hours. You don't want to try to get downtown at for an appointment at 8 o'clock or 9 o'clock. You want to make your appointments at 11, between 11 and 2, so you can get out of town before the other traffic goes the other way. But other than that, it's great down here. It really is.
Steve, thank you for appearing on Apollo Papyrus. You were an amazing guest.
Well, thank you very much. Thank you very much. It's good. It was good talking with you.
Steve was an insightful guest, and it was wonderful to have him on this podcast. This is Aaron Apollo Camp reminding y'all to write and read your passion. Bye for now. Remember to subscribe to the Apollo Papyrus YouTube channel at www.youtube.com/@ApolloPapyrus and the Apollo Papyrus Substack newsletter at apollopapyrus.substack.com. Y'all can visit the Apollo Papyrus website at campaaronapollo.wixsite.com/Apollo Papyrus and follow Apollo Papyrus on Threads, Instagram, Facebook, and Tumblr at Apollo Papyrus. Copyright 2024, Aaron Apollo Camp, all rights reserved. This podcast episode is intended for the private listening of our audience. Any reuse or retransmission of this episode without the express written consent of the podcast host is prohibited, except under fair use guidelines. Royalty-free music and sound effects obtained from https://www.zapsplat.com.